what do you like going more macro? What do you look for in a market before you guys start digging in and looking at homes? How do you screen different markets? Is it as simple as like, hey, I just know that this is a great place? Or are you trying to find new emerging markets? Or are you looking at existing markets, figuring out how you can carve out a niche? I mean, what, just give me your thought process on the, how you macro analyze entering into a new market.
Yeah. So, first thing is it legal? With
Yeah.
regulation, with rules, you got to start there. So, first is navigating the rules and regs. Can you play ball there? How does it work? How's the permit process? Is it by zoning? Is it by density? You need to figure those out. Once you've established that, everything in this asset boils down to two simple factors. So when people look like, hey, I can envelope underwrite, a deal and know if it's going to work or not, or if it's worth diving into based on purchase price and based on revenue. So those are the two things I always look for. And, you as an investor, you can figure out, okay, we call it the price to revenue ratio. And that's pretty much what's your revenue divided by purchase price. So if you have $1 million property, it grosses 200 grand, that's a 20% price to revenue ratio. Pretty easy math there. So, we have our own standard where, we don't try to buy anything under a 17.5%, revenue to price ratio. Now, we have our costs, of operating, et cetera. And, based on the cost of debt, that's also going to affect it. When debt was cheaper, we had 3-4% interest, you could still get the same yield at a 15%, price to revenue ratio. So that number is always going to change based on the macro environment with your cost of debt, which is your biggest, line item in operating a short-term rental. So,
Right.
those are things you need to look at. Now, an individual operator, you might be super lean, you might be close, you might do some of the tasks yourself. So for you, you might be comfortable with a 14% price to revenue ratio or 15%. So kind of figuring out what's your benchmark, what's your minimum, and then seeing, does that market support it? So, let's just use round numbers, say we're at a 15% price to revenue ratio. If I'm seeing gross revenues for 3 bedrooms at 75 grand, give or take, in a given area, and all the homes are listed at 600,000 or more, it doesn't matter. That's not going to pencil. That's like a 11-12% price to revenue ratio. However, if I'm starting to see stuff for 450, I'm like, okay, this is worth diving into because there's enough spread there between, average gross revenue and purchase price. So for us, we're going to start, hey, is it legal? And then we're going to go look at, okay, what are the spreads? So what is the revenue being generated in this town? And what does it cost to buy that revenue? So for
Yeah.
us, we'll actually start and download, all the revenue listings from a given market. So we have some great data partners, that, are happy to work with us, and we, provide that information. So once we kind of dissect that and figure out, okay, what are 2 bedrooms generating? What are 3 bedrooms, 4 bedrooms, 5 bedrooms, et cetera? What amenities do you need? Then we're going to go look at the current supply of listings in that market and see, okay, can we go buy this type of product and make the math work? If so, then we're
Yeah.
going to go dive in and be like, okay, how many is there? What are we going to forecast for, typical inventory? Is there enough supplies? There are only 2 homes currently that check the box. Probably not enough supply to enter that market. If there's 25, 30 homes that check that box, well, now we're cooking.